Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Hello and welcome to the early edition of Your Money Radio. It is Tuesday, first day of Fed Day, Tuesday and Wednesday, and we're doing something a little bit different this week, folks. We've got commitments later on in the week, and actually our producer, Zach, is going to be out of town later this week, so we decided to do it a little bit early. And by the way, before I forget, Don will be out next week working from afar, so Ted and Connor will be stepping up and doing the nightly videos, tomorrow's Insight videos, starting next week or maybe even this Friday, so stay tuned. And because we don't have all the weekly data for this week, because again, it's just Tuesday, I thought it'd be fun to do something a little different and simply have a roundtable where we just go around the room. We go to Don, Ted, and Connor and kind of go around and let each one of them kind of give their favorite five stocks or SEC ETFs, whatever, their favorite five positions out of their 21 over 21 list, and give you the reasons why and what we're looking at. Now, before we do that, and again, since it's abbreviated week, we've got an abbreviated mailbag, but I already did get one article from a listener, and they're all in the show notes, and this is actually an article in the Wall Street Journal. It is a subscription model, but a lot of people get the Wall Street Journal, so I put it in there. And basically the headline is, girlfriend gets $1 million, a girlfriend from 1989. So what is that, 30 years ago, 30 plus years ago, gets $1 million from her ex-boyfriend when he passed. He apparently forgot to update his beneficiary designations. Now, it was pre-electronic, pre-technology, and so he did a handwritten card, and then when they apparently updated in the system, Fidelity never updated their electronically, their system, where it stayed, whatever it was. She was still on there decades later. And guess what? She got the money. So you've got to be careful, and you've got to update your beneficiary designations. True story, my former partner, Dan Kofal, when he passed, he hadn't updated his beneficiary designations, and he had a ex-wife that he had been divorced for about a decade that was still on there. Now, under the laws of Texas, as soon as you get divorced, that automatically terminates all beneficiary designations unless you add them back on. You got to manually add on a former ex-wife, not a girlfriend, but an ex-wife, in case you have alimony or for kids or whatever. But she was still on there. And even though my former partner and myself gave the insurance company notice saying, hey, this is 10 years ago. She was supposed to be removed and you didn't take her off. And we told them, they actually paid her. We actually had to file suit to get that money back, to claw that back. So beneficiary designations are very important. And before I go on, I know I've said this a few months ago, but I want to bring this up again, folks, because people don't understand beneficiary designation. So if you're a mom and dad or a single parent, you got 3 kids, and you and you want them a third to your kids, assumably you'll have you and the wife, or if you're single, just the 3 kids, but the kids would either be that second layer, or even if they're the primary. But let's just assume you're a single parent or a widow, and you've got 3 kids, and you have them a third, and they've got kids, and you and one of your children go out to dinner and you get killed in a car wreck together, you assume that kid that died with you, that their kids, your grandkids, their kids would get their third. That's not right. Everybody's got to be wiped out at the primary level before any contingents gets paid. That's why it's very important, if you've got 3 kids and you want it to go down the bloodline, You've got to add a thing saying per stirpes. Check the box. Says that means that's Latin. It means down the tree branch, but it means down the bloodline, so that if one of your children predeceases you, it still goes down the bloodline. There's also a thing called per capita. I don't want to dive too deep in the weeds, but beneficiary designations are important. You should review them at least once every couple of years and make sure they're accurate. If you've got any questions on that, you can certainly call me. And the second and third, I got a couple other articles talking about the Fed, because everybody's talking about the Fed today and tomorrow. And this article is, the Fed won't move interest rates this week, but the meeting is a feast for economists. So these economists are all coming out of the woodwork, putting in their 2 bits. And they said that, basically Jerome Powell's expected to repeat that the Fed is no closer to gaining confidence of inflation moving back to target. So they're going to kind of remain pat, keeping interest rates the same, and you're going to be tighter for longer to cool inflation. If that's right, this means the first rate cut could happen at one of the last FOMC meetings this year, September, November, December, or not even until 2025. We have CPI data coming out, I think tomorrow morning, Wednesday morning, and the Fed's decision, could be affected by that. Now, here are the 5 questions these economists are going to be asking, trying to infer once he reports. 1 or 2 rate cuts this year? How many Fed officials will pencil in 0 rate cuts this year? In other words, a few of them are saying we don't need one this year. Inflation's is being, like I said, sticky. It's being resilient. We don't need to cut. Third question, will there be any changes to Fed's overall narrative? And could Powell guide investors on how to read the inflation data? And will there be any talk next year? And we've got 4 different economists, the chief economist for JPM Chase. We've got one from BPM Paribas. All these people have a couple different ideas on what the Fed could say. Folks, that's an awful lot of mistakes. I mean, these economists are only 50-50 at best. Their forecasts are inaccurate. But here's the thing, even if they get their forecast right, it doesn't mean the stock market or the bond market behaves always like they think, even if the report comes out right. What I mean by that is they're not always correlated to the outcome. There's not a perfect correlation. So even if you get the item or the interest rate, whatever you think is going to happen does happen, that doesn't mean the market still will respond how you want to happen. So here at Revere, we measure what is happening while it's happening in real time and make adjustments accordingly. We let the economist, we let the forecast, we'll let the economists stick to their own forecast. We don't really care. The only thing we care about is price, because price is truth, and it's your money. It's not their money. It's not their money to play around with their forecast. So that is why we actually have a sell discipline. We've got buy and sell rules. We know what would make us get into the market and what would make us get out of the market in real time in advance, so that when it hits the fan and we're under fire, we're not trying to make a plan, come up with our plan while bullets are whizzing over our head. You want to have a plan in place, like you're at the beach sipping pina coladas and there's no pressure, you're relaxed. And so that when battle does come, you're already ready, you're already prepared. So with that, let's go straight to Don and the team, and let's find out what they're looking at in the markets right now in real time, and what each one of their 5 favorite positions are. So with that, Don, I'm going to turn it over to you.
Sure, Dan, thanks. We're going to start off, as we usually do, with a high-level view of what's going on with the S&P 500, and it's clear from this 15-minute that we had a 4 days up, and we are now on the 4th day of a consolidation above the 53.30 level to the downside and 53.75 to the upside. We talk about this all the time. We see it all the time. Stocks don't go up or down in one direction without stopping. They rest along the way. They can only do one of three things: trend higher, trend lower, or prepare for a trend higher or a trend lower by consolidating and going sideways. And this is a technical analysis 101 example of 4 days up and a 4-day sideways consolidation. Now, technical analysis says that a consolidation should resolve in the direction of the primary trend. If you step back to the daily chart, you can see the primary trend is up. We're consolidating. So a breakout higher above this 53.75 level, all of that consolidation to the upside, which is the direction of the primary trend right now. On the other hand, if that fails, then that gives you feedback that the market is not ready to go higher, particularly this 53.30 level, which we touched this morning on a pullback and bounced perfectly off that level. If that level would break, that would get us back into this 4-day range where we had the uptrend, and the market at that point would tell you that it's just not ready to go higher. No reason to get overly pessimistic about it. If that happens, you look to your prior low for support. That's down around 51.90. So no reason to get upset or uptight with the market unless we break below that prior low, 51.90, which also would be a break below this red line, the 50-day moving average. So that's a high-level overview of the markets right now. What did we do in-house? We participated in this 3-week uptrend. When we broke below the 21-day moving average, we started lightening up a little bit. Market did 3 fake outs to the downside and then broke to the upside. So as we recovered and we saw some good action in leading names, and some leading names broke down, there was a change in character of them and they haven't recovered. So those are taken off of our list and replaced with healthier stocks. And that's a good segue into what we're going to do. The analysis section of our program, we're going to, everybody keeps, I discussed the 2121 on the nightly videos. Each one of us keeps our own separate 21 over 21 leaders list. It starts off with a list of sectors driven primarily by the 33 sectors that Investors Business Daily uses. It's also driven by the 12 spider sectors. And then we assess the overall health of each of these sectors. Part of our weekend analysis is to determine, are the sectors strengthening or weakening? Pink, orange, low represents weakening sectors, and shades of green represents whether or not it's strengthening. And that just carries over. So once we've got our sectors identified, then we look at the leading stocks in those sectors. Everybody creates their own 21 over 21 list. And we review the stocks in them. We're each going to pick 5 from our list and go ahead and review them. And I'm going to start off with Ted's, and then we'll go to Connor, and I'll do my 5 lists. So Ted, take it away with a name that we added to the Growtection portfolio yesterday. This was on your list and on Connor's list, and we took a swipe at it yesterday. Let's start off with TMDX. Take it away, Ted.
Yep, sounds good. So I talked about this on the podcast, I believe, on the gap up day, and the day before the gap up, it wasn't quite liquid enough for Grow, so we decided not to enter the stock. But we've been monitoring it for the past few weeks, and we finally got a small little pivot here, a small little range, and we just started off with a 1% position just to get ourselves in it. So it's just back on our radar. This company really excites me. So essentially what they do is they have this organ care transplant for transporting organs between hospitals from the donor to the patient. And what they found was this is a lot more efficient than the traditional or legacy cold storage, and it keeps organs more fresh and alive for the patients. And there's a huge demand in this country and the world for organ replacement, massive lines for it, and this just only speeds up the process to get people the organs they need and to save more lives. And this company has just massive earnings acceleration and surprise. This previous quarter where it gapped up, it had a surprise of 800% on 538% year-over-year growth in the second quarter of earnings acceleration. And from that, they had guidance raised as well. On the revenue side, they had 133 year-over-year sales growth on 16% surprise, and they had 9 quarters in a row of triple-digit sales. So this company does not lack in both earnings and sales. And we know that in growth stocks, revenues create more earnings, and then earnings ultimately get Wall Street and institutions to buy the stock. Additionally, on that earnings gap, it came out of a neglected 9-month base, and that is something I look for as well, because after a long period of digestion, especially when there's a news or a catalyst, that can really trigger long and sustaining moves. So that is what we're expecting. And so this recent setup, when you look at the setup, it went up pretty much 100% in 8 weeks, and it pulled back only about 12%. So that just shows there's little to no sellers, and this is starting to meet that William O'Neill high tight flag. And the reason we only took 1% is it's still a little bit short. What we would like to see is this right side build out a bit more, and then we'll look to add on to it. The second name, Don, if you can pull it up, is Coinbase. Everyone should be quite familiar with Coinbase. It's the largest US regulated crypto exchange. Bitcoin is leaking off today, breaking down, but still holding the lows of its range in that 66,000 area. Coinbase is actually acting stronger relative to Bitcoin while it's building the right side of its base. So it does not seem quite ready here, and same with Bitcoin. It did look ready last week, but it rejected the 72,000 area, and now it appears it needs some more time. But that doesn't mean it's dead yet. And Coinbase, we know that they've kind of differentiated themselves. They're kind of moving into other areas to generate revenue instead of just the traditional crypto broker or exchange. They are the custodians of nearly all the Bitcoin ETFs, so they receive fees from there. They recently released a Coinbase wallet that aims to get rid of like the 12-word passkey with newer ways of security, which kind of makes it easier for crypto users and investors to hold their crypto, but not fear that they'll lose their 12 passkey. I mean, as we've seen, some people have lost hundreds of millions in Bitcoin just forgetting their password. And their goal is really to be the crypto super app. So with like proof of stake blockchains like Ethereum, they work with them as well, and they generate fees from there as well when people stake their coins in. And for this, I'm really just keying in on that 265 level. Right now, it's continuing to build and find support at that previous little breakout level. So I want to see that hold this 250 area, plus or minus 5 to 10 points, and just see a handle build out. The third name is HIMS. It's another medical products company. Traditionally, they have treatments and pills for erectile dysfunction and premature ejaculation. But recently, you see that huge candle that was catalyzed by the release of a GLP product, which is much cheaper than Eli Lilly's and NVO's, and that really saw some demand, and it kind of exhausted itself on that first day and formed a U-turn, and now it's made new highs. And this is extended at this point, so I'm not looking for an entry. I really want to monitor and see how this acts going forward. And then the fourth and fifth ones, it's just part of the build out generative AI, 2 chip stocks, MU, Micron, and ABGO. They're actually both just breaking out of their bases right now. So we own MU. We don't own ABGO, but it does look really good. I believe it's making a new all-time high today. And so those are the final 2 stocks I'm watching. MU actually, it's a turnaround situation. They had multiple quarters of negative earnings and sales growth, and in the most recent quarter, they saw 121% growth at 42 cents a share and about $6 billion revenues at 58% growth. So just watching these two as the demand for data center chips and AI continues.
Good stuff, Ted. One thing I want to note with MU, and we saw this last week on a bunch of AI data center names when Dell reported earnings, and they were very underwhelming. There was a much higher expectation that they were going to be able to show acceleration because of involvement in data center. We know that Jensen Huang, the CEO of NVIDIA, has been touting Dell servers, but you can see the big gap down, and that gap down carried through to a bunch of different names in the group. You can see that Dell's gap down, it hasn't responded, but you can see Micron, which got caught up in that AI data center sell-off, responded and made new highs. This is the type of reaction that you want to see, and it confirms the fact that something is a true leading stock. And also you can see the relative strength line confirming that new price high. Compare that to something like VRT, which we got stopped out of, that got caught in that data center sell-off too, and also hasn't recovered. So this is a way of the market separating the leaders from the laggards when an inflection point like Dell disappointing earnings happen and it carries over to a bunch of cousin stocks. You want to see which ones are able to bounce and react from that, and which ones are, so let's say which ones are tennis balls and which ones are eggs, I guess you could say. And this is a good example of VRT, unfortunately, turning into an egg. Now, it's had a great run, but they all need to build a base at some time. We were in VRT after it reported this gap up on earnings and continued to show relative strength afterwards. But that was a change in character with that Dell earnings disappointment and also 4 days of high volume selling, and it just really hasn't bounced back. So you can know the story as much as you want to, but sometimes stocks just need to form a base, and it's up to you to decide whether or not you're going to sit through that base or whether you're going to move your capital into just acting better. In this case, if you compare MU and VRT, not in the same sector, obviously, but still both have ties to data center AI hardware build out, and one responded and one didn't. Good stuff, Ted. Let's go over to Connor, and we're going to kick off with he's got at least 3 pairs of these ONON. Let's start off with that one.
That's right. Product research right there. So ONON, a lot of things caught my attention on this one, and the main thing that caught my attention with this one was the overall group. Shoe stocks are a relatively smaller group, but there are still 3 or 4 names in the group that led me to this one. So Deckers, Crocs, and Skechers, which I talked about on the podcast last week, those were all shaping up, and ONON had a really big weekly base, and it broke out of this weekly base on an earnings catalyst. And what they had was they had 22% year over year revenue growth. They added some high profile ambassadors for the brand, and then they also had 137% EPS beat. So that and yeah, when a stock breaks a 1 year period of neglect on volume on a catalyst, that really gets my attention. And as you can see in this chart, the relative strength line shot up, and it's been offering some opportunities on this run up. Because once it cleared that level, we've been looking for spots to add on to this one, and this stock has been acting really well. And it's a non-tech name as well. We've seen the deterioration in breadth for tech stocks, and sometimes having some other sectors in your portfolio can smooth the equity curve. And yeah, today this shot up to a new high earlier this morning, came back in with the market a little bit, but overall it's been acting really well. And given it's just coming out of this IPO base, it's still under IPO highs. So if we have the market wind behind its back, this could be a good position trade. Next one is NXT. And this, we traded this in the past. It's new issue. It's a recent IPO in the solar sector. And as you can see, past price action has been pretty choppy, but you can see on this right side, huge change in character. It had huge volume on the right side once it bounced off the 200-day moving average. And then just yesterday, on Friday after hours, it was announced that they're being added into the S&P 400. And so it had a strong day yesterday, which we added to the position. And then just one thing about the company, which I like, is NXT has something new to it. Basically, what they do is they have a software that tracks solar panels. The software tracks the sun across the sky throughout the day, so it tries to help the solar panels get the best amount of sun, and this saves costs and allows the panels to capture more sunlight. So it's definitely new. It's one of the only companies in the space that's really targeting that aspect of the industry, and price action wise, it's acting really well. After that big move up, it had a consolidation, and now it's trying to get out of this shelf as well. And then just the super favorable backdrop of the solar group. If you look at TAN, it just broke out of a stage 1 base, finally got above the 200-day moving average, and you have First Solar, which we also own, which I would say is the #1 leader, but you can always find the top 1 to 3 names in a group when it's moving, and I view NXT as in the top 3 of this group. And then next one is PSTG. So we've been sitting in this one for a couple of weeks now. We bought it on 5.6 as it was making the turn out of that base. Yeah, it had like that low cheat setup. The moving averages were coiled, and it's had a nice move. That earnings reaction was a volatile day. It gapped up big and then came back down into the 21-day, but it's bounced and it's falling through right now. But one thing to note about this group is this is like these computer data storage stocks. Micron's one, Western Digital's another, NTAP, STX. All of these stocks look poised to be breaking out of some decent multi-month bases. So they're not really extended at all. And this specific niche of stocks have been acting really well. And Pure Storage is one of the leaders in the group, as it's already broken out of its base, but Micron looks great as well, and other names in the group. Then if you go to mRNA, so this is, not a typical name that would usually trade, but, when stocks go through the price cycle, and mRNA had a change in character right on that day Don's pointing to, it broke out of this base on volume. And if you look at this in the base, there was huge volume. And so some catalyst that's been driving this move is the FDA approved the RSV vaccine. They've had positive clinical trial data, and then there's been concerns about a new bird flu, and mRNA would benefit from that. So on the chart right now, just basically watching this flag, it's right at the 21-day after that big move up. So clear downtrend line. So if it breaks that with volume, could be actionable. And then Reddit's the last name. Another new name. It's got a really nice IPO base. And one thing to note is this year, some of these stocks coming out of these IPO bases have gone on to make really big moves, and ARM's one of the most notable ones. And there's been a few others, and they all had similar price action and charts before they finally got over that IPO high. And some of the catalysts, some things that I like is for Reddit is the partnership with OpenAI. They have a lot of increased user engagement, and then just the broader market trend. Obviously, most people are probably aware with the GameStop stuff and all that, and that brings a lot of people to Reddit that have never used it, and that's going to be a positive for the company. And and whatnot, and just more social media chatter about stocks. And this name, I think, could benefit from that a lot. So yeah, we'll be watching this one to see if it can clear those highs and make a run.
Good stuff, Connor. 5 solid names. And I want to point out again, PSTG, just like Micron, got caught up in that Dell sell-off. And it's a tennis ball, not an egg. Bounced right where we wanted it to at that 21-day moving average and resuming its relative strength line uptrend. 10 solid stocks from the fellas there. I'm going to go through 5 as well. I'm going to start out with the biggest holding that we have in Grotection. That is CrowdStrike. We initially got into this when volume started coming into it as it was attempting to bottom in the base that it was forming. Relative, it did up higher. And then as it got to the top and started to form in a handle, there were several AI data center and software names that reported earnings all in the same day. I believe it was ServiceNow in this case that reported terrible earnings, and quite a few software names, not necessarily cybersecurity names, but they all started selling off. A lot of people grouped these SaaS type stocks into one big pool. We got stopped out. We went from a 10% gain to basically flat when we got stopped out when it broke the 50-day moving average, but kept it on the watch list. We noticed that reported a beat and raise quarter, although Zscaler has a much worse chart. CrowdStrike reported last week and was also beat and raised. Volume started coming into it. It got back above the 50-day moving average. We've done 3 buys on it since then. And sometimes you get lucky, and it was added to the S&P 500 on Friday, completing the breakout of this kind of jagged cup and handle with a very deep handle. But you can't ignore the volume. You can't ignore the price action. This is a case where we keep things that we get stopped out of on our universe to see if it comes back and deserves another look. And this is one that deserved another look, and we got back into it.
Hey, Don, real quick. I want you to tell the listeners, isn't CrowdStrike's the one that you were watching the after hours earnings, and as soon as they reported and it had a little gap down and then started coming back in after hours, you actually snuck in and bought some after hours on your first buy, right?
Yeah, the algos, they know where that +1 and the -1 times expected moves are. The sentiment was very negative on this, so a lot of people were on edge. The algos took it right down to the -1 expected move. It bounced right there, and when it reclaimed the 50-day moving average, as it started to bounce after hours, we took our first stab at it, added 2%, added another percent the next day, and then added another 3% as it came up to this 350 level. And then with the S edition, it's continuing to hold up its strength. So yeah, that was one that we bought after hours initially. Moving on, a lot of people have been talking about NVIDIA because of the 10-for-1. Not only is it the leading name in the entire market, but as what was going to happen after its 10-for-1 after the close Friday and Monday morning. I must have read 25 people on Twitter that said they're waiting for the Monday morning gap up to short it. And that happens a lot after stocks do splits. It runs up into the split and then it sells off after the split. But NVIDIA had a very nice reaction yesterday. It initially sold off a little bit after the open. You can see right here, but it found support right at this split adjusted 117 level, which was a prior breakout level. And it's bounced up since then and is having an inside day today, which means the high of the day is lower day's high and the low of the day is above yesterday's low. So as long as it holds this 117 level, there's nothing to be concerned about relative to a post-split sell-off. That also corresponds to the 8-day exponential moving average, which has been supporting it during this most recent 3-week run-up since its earnings report.
Do you think that 10-for-1 split is to get on the Dow? Because the price
I think
went-
that factors into it. I don't know. Well, they could have done 8 for 1. They could have done 7 for 1. I don't know why they did 10 for 1, but
Well, I think
it
they're
certainly
worried.
makes it.
The Dow, to get added on the Dow, they really want you. The sweet spot is like 180 to about $100 to about $200 a share. They don't want it too expensive. So if they don't do a big enough split and then the stock runs up 20%, your split didn't work. It wasn't enough. So I think they kind of did what they thought would be enough for sure.
Yeah, you can see the highest price stock in United Healthcare, peaked at 555, and this moved down to 436. This was just primarily responsible for the sell-off or the underperformance in the Dow Jones Industrial Average because of how highly priced the name is. So yeah, they didn't want to split and then double again, and then it's right at $400, and they can't add it to the Dow. Yeah, can't get in either. So we'll see about that. Third one I'm going to show is Cava. The fellas brought this one to my attention back here. We got into it for Grotection, rode it up, survived an earnings shakeout, to it, and there was an insider putting up a 6 million share block that it sold off. We locked in some profits on this last week. Now, then the question is, when you have something like that, is it going to be a tennis ball? Is it going to be an egg? Well, it held at that 21-day moving average right where we needed to, and it's bouncing off of there nicely. So we'll be looking for a low risk opportunity to increase our position size in this one as well. Fourth one is First Solar. They got an upgrade today. I think the buy might have been back here. Hold on a second. Might have been back there. And then First Solar had a history of running and selling off. So genius that I am, took some, when it got extended for ATR from the 21-day, I took some off, and it just laughed at me and continued to run higher. We kept half of the initial position that we bought, waited for go through this 2.5 week consolidation that it did. It got an upgrade this morning, and you can see the volume and the price action. We added that sell back, and we never have a problem adding back higher when we sold something lower, because part of it, that's just your ego keeping you from buying something back at a if you won't buy something back at a higher price than where you sold it at. We have no problem doing that. We do it all the time because stocks change character and the situations with them change. And Connor brought up a very good point with NXT. This also carries through to First Solar. This upgrade this morning was tied to the AI data center power needs. I mean, if you're building these massive data centers, it just makes sense to put solar panels on the roofs of them. And if those solar panels are using First Solar panels and NXT tracking underneath those panels to keep them in sync with the sun as it crosses the sky, that's basically free energy for these companies. So outside of the cost of the hardware, obviously, but so First Solar is number 4, and we're going to wrap it up with an inverse ETF that we're in, SARK. Kathy Wood seems to be having lately determining what are leading stocks and what are not leading stocks. And you can see ARKK, we went through the top 10 holdings in this, and 7 of the top 10 holdings are in downtrends. So a nice little hedge for the portfolio. When ARKK rallied up into the 200-day moving average, it was a good low risk entry. We've got a small profit in this right now. We'll stop out if it gets back above the 21-day moving average, or if we see a big positive response to CPI or the FOMC over the next couple of days. But it's a hedge for the portfolio, taking advantage of an ETF that is supposed to own the strongest stocks, but is not holding strongest stocks. And that's not our opinion. That's just a fact based on the downtrend and the relative strength line. That's number 5, and those are 5 from each of our 21 over 21 list, giving a little bit of insight into the process that we use every week and weekend. The weekend is when you get a lot of the work done preparing for the upcoming week. It's the preparation when that meets the opportunity that's where you can make the money. So this is a 7-day-a-week job that we do, and if you didn't love it, you wouldn't be in this field, and we do love it. We eat it up. We're texting constantly, giving each other ideas and supporting each other, and couldn't be happier to work with everybody that's on this podcast right now. So back to you, Dan. You can take us on home.
I guess you're right. When you said, Kathy's just not in the leading stocks. Why is she not in the leading stocks? Again, folks, price is truth. It's not opinion. You need rules. Now, I was going to ask Don about his analogy because I have not heard that before, and I'm a former tennis pro, right? I haven't heard, is that an egg or a tennis ball? I think that's a classic. So the question I got 2 questions for you, the listener. Number one, are your advisors working on the weekend and distilling charts and looking at 100 charts to figure, or even more, to figure out which are the best to make their 21 over 21 list? And my second question is, what's in your portfolio? Do you have eggs or do you have tennis balls? Hopefully you got tennis balls. Folks, listen, if you like what you heard, please tell a friend, tell a neighbor. Go up to just to send them to revereasset.com. Up in the right-hand corner, there's a subscribe button. You can put in your name and their email address. We're not going to hassle them. It's up to them to reach out to us. By the way, there's a contact us button right next to the subscribe button, and it'll send me an email directly if you want a complimentary portfolio review, you want a topic discussed on the show, or anything like that. You can also, and on that subscribe button, Don sends out a daily market insight video. Folks, we do a video, 10 to 15 minute video, every night the markets are open, telling you what we're doing and what we're looking at. You can email any of us, dan@revereasset.com, don@revereasset.com, Connor or Head at revereasset.com. And you can always call us old school at 855-REAL-WEALTH. Folks, we'll talk to you a week from this Friday on your money.
Because it's not how much you make in the markets, it's how much of that you can keep.